Hello, this is the promised follow-up video after my two SPAC videos, or special purpose acquisition companies. You can check out those videos if you follow these links here. In the first one, I describe what SPACs are. And in the second one, I describe why it isn't the investment opportunity that justifies all the hype right now in SPACs. And one of the reasons that's the case is because there are pipe investors kind of outside the SPAC investors in these vehicles. So what is a PIPE? Is a private investment in a public equity. So if you think about a public company, there are times when they might need to raise capital, right? So they might have an acquisition they want to do. They might have some special product launch. They may need it for just day-to-day operations. They're low on cash. So they might do this. And now there are traditional channels for acquiring capital, such as a follow-up or secondary offering, issuing debt, things of that nature. So if we think about these follow-up offerings, company has to go out there. They have to create a prospectus. They have to register with the SEC. There might be other federal regulation requirements. They might go through an underwriter who then kind of takes some of these proceeds for doing this work, and it's time consuming. That's kind of a traditional method of doing it. So companies are starting to use PIPE investors, private investors to acquire this capital need. So what they're doing here is they're going out to an investment firm, a mutual fund, so a large accredited investor, and they're soliciting capital from them, right? And the key here is they're able to do this without going through these SEC regulation type channels. The drawback is that they're, in order to get this done and whatnot, they're gonna offer these shares at below market value. So, and there's also kind of two types of pipes. There's a traditional pipe. That's when you're going to issue common stock or a preferred stock that has some predetermined way of converting that to the common stock. Or there's going to be a structured pipe where it's a little more complicated. You're going to use a preferred stock or some kind of a debt security that is eventually convertible to a common stock, but it's not as predetermined as it is in the traditional pipe. So there's kind of two different channels companies can use there. There are advantages, as you might guess, that you can do this really quickly. So with a secondary or follow-up offering, it might take a few months before you get the money here. This can be done in a few weeks. The requirements in terms of filings and regulations are not as stringent here because you're dealing with accredited investors. It can end up costing a lot less. You're not paying those underwriters for their work there. As a pipe investor, it's actually nice because again, you're paying below market value for these securities. It's not to say there aren't disadvantages, right? So when you do this, just like with any kind of secondary or follow-up offering, whether it's a pipe or a traditional one, there's going to be some dilution effect there. Because of that, sometimes these pipe capital raises require shareholder approval. You are limiting the buyer pool for this because you need to be working with accredited investors. So you can't work with traditional retail investors here. So you're limiting that pool. And then of course, because you're offering the stock at a discount, then maybe you're not going to raise as much as you would through the traditional channels, kind of depending on how that cost versus discount plays out. Now, of course, I was talking about SPACs. Why does this come into play with SPACs? The idea is SPACs have become really, really popular. They're going through the roof. But as I mentioned in my previous video, the returns there aren't that great for kind of these the main like the SPAC investors, because the people that create the SPAC, and there's these pipe investors that are getting the better deal than the SPAC investor. So if you're looking for a way to invest in SPACs, don't do it directly to the SPAC. Invest in a pipe that invests in the SPAC, and you're actually going to end up with a better deal. So keep that in mind. I really think if you want to get into the SPAC territory, this is a better play. The data that I showed you in that second video shows you that the SPACs versus traditional IPOs don't even come close to comparing. The traditional IPOs are a much better investment. So keep that in mind, despite the fact that there's all this hype right now about SPAC investing. I'm Brian Kozlowski. I hope you enjoyed that. Thanks so much.